55th webinar, which we are doing on every Friday, 4 to 6. And today we are not merely discussing a new law, we are discussing and witnessing the beginning of a new philosophy of taxation in India. Our endeavor is always there to proactively organize things. So when the law is implemented and either we are ready, if the government is asking suggestion, then we are ready to provide suggestions also. The Income Tax Act 2025, effective from 1st April 2026, I think it is not just a legislative paper, or it's not a replacement only, but it is something great which we will see. So in my opinion, what the government is saying and what the lawmaker is saying, they are projecting that it is from complexity to clarity, from suspicion to trust, from enforcement-driven administration to behavioral-driven compliances. Now, these are the points which is coming out in the law when they have proposed. But our expert will tell us whether complexity is reducing or suspicion is becoming trust-oriented or enforcement-driven versus behavioral way. That our expert will tell. It is in the core that new act simplifies structure, modernize language, embraces the digital governance, and recognize provisional logically. It is reducing section from 819 to 536 and chapter from 47 to 23, while preserving continuity in core principle. It is also a big achievement if they have achieved by reducing this. More importantly, it signals the India's tax system is preparing itself for the more different economic future, one that is digital, global, and data-driven and compliance-sensitive. Friends, today we will discuss in this webinar the genesis and the objective of this webinar, structural overview of the new act, key changes affecting individual taxpayer, implication of business and corporate, what that will be there, and transitional period and its provision and how the implementation challenge will come, strategic preparation for financial 2025-26 and beyond. This is the theme of today's program, and that's why we have invited the very learned panelists for today's webinar. If you see, we have a practitioner, we have a bureaucrats who has worked in this department, we have people who has participated in this lawmaking. So I welcome first our speaker and panelist, Mr. Girish Ahuja. He is distinguished tax expert, chartered accountant and academician. He was nominated by the Government of India to the task force of redrafting the Income Tax Act. So he can tell inside of this. He has served on the board of several reputed companies, including nomination as director of Unitech India, an independent director of board of State Bank of India, and also a renowned author of Speaker on Direct Taxes. And he is a, I think, any student who is a tax student who is not knowing Girish Ahuja ji, that difficult. Ahuja sir is joining. So I welcome him in his absence. Then our second speaker is Mr. R.K. Agarwal, is a senior chartered accountant, strategy and dispute resolution expert, and over 3 decades of professional experience. He specialized in income tax litigation, search and seizure cases, tax planning, and strategic business advisory for corporate and high net worth individual. He is managing partner of Rakesh Raj and Associates, a prolific writer, author, speaker. He has co-authored leading taxman commentaries in several key committees of ICI, ICSI, including chairman, NIRC, and ICSI. He was party to the, he was there, and he has worked so many new innovative things wherever he was in the committees. Then our third speaker is Mr. Rajiv Kumar. He's Indian Revenue Services Officer and retired Principal Commissioner from Income Tax Department. He has worked in various jurisdictions in India. He commands over the subject, and his knowledge relative to this and insight is superb. And today, when we will discuss the topics and he will speak on this, so he was also instrument to suggest government of various changes in this law. So he will understand that what was the thought process of the government and how it has come out. So I welcome Rajiv ji for your presence for today's program. Then we have Mr. Rakesh Gupta, who is distinguished tax professional, advocate, former member of Income Tax Appellate Tribunal. He is fellow of ICI and ICSI and associate member of ICMI. He holds an LLB with a university, gold medal and PhD in corporate governance and business ethics. Mr. Rakesh Gupta practices before the ITAT, High Court, Supreme Court, and representing UP government as special counsel. Frequently lectures on union budget, direct tax, and any topic of direct tax. Rakesh Gupta is a prominent name in this. So friends, all these speakers today, they are from different fields. They are practicing, so they know, and it's a very powerful panel today. Now, friends, before going to this, I just want to make the theme and topic so everybody should understand that what is the what we want to discuss and what are the happening. So, in my opinion, what changes this law will bring? That is one, the three deep structural shift will definitely impact the entire corporate world. Number one, behavioral transition of tax culture. Over time, taxation will increasingly becoming less interpretational, less negotiational, and more algorithms. This will fundamentally reshape how professional business and even the administration operate. That is number one. Second, tax will become a strategic decision, not just compliances. For corporate clarity and stability in its provision, allow management to focus on business strategy rather than procedural interpretation. And tax planning will move from year-end adjustment to real-time strategic modeling integrated with ERP and decision making. And that's why we have seen this year budget that every time when budget is coming, so there are two top chapters, direct tax and indirect tax was prominently there. But this time we have seen very few changes in this, and the part A was more dominated in the entire budget speech. Third is the social contact between taxpayer and state. If implemented well, the act can build what I can call a trust capital economy. A predictable and respectful system naturally encourages voluntary compliances and reshape the relationship between taxpayer and administration. But let me be honest, and I just want to see this also, that whether everything which I am just mentioning and this is the aim of the government is really implementable, how the direction are clear, certain area which are really need more clarity. So that is one part is how digital and behavioral enforcement framework will operate in practice, because saying is easy, but implementation is tough. Then alignment between legacy tax litigation under the old act and forward compliances, which is the plan of the government. Readiness of software ecosystem and professional for computational framework, how this will take place, how consistently the administration will implement the philosophy of trust embedded in the law, which they are saying, because always taxpayer is always not seeing in a correct way, and Rajiv ji will tell us that why this mistrust. These are not weakness. These are the natural transition when you are changing new law to old law to new law, and you are changing the systematic changes you are bringing out. Now, I always try to do that when this type of programs are taking place, we should identify some suggestions, and that suggestion will be part of the discussion. So what government can innovatively do next? These are the changes which are there, but larger issue is there which industry is always asking. Number one, introduction of tax compliance score. This is one suggestion which I am giving, which is a broader policy vision beyond statutory reforms. One transformative step could be introduction of tax compliance score like a credit score framework to measure discipline and behavior across the taxpayer life cycle. The score may be based on timely filing of income tax return, accuracy of disclosure, then a timely payment of taxation, compliance and litigation history, responsive to the notices, and how consistency between reported income and financial data which you have provided, and how all the high score taxpayer may be given privilege such as faster refund, reduced scrutiny selection, priority processes of application, simplified compliances procedure, and recognition of trusted taxpayer as a name. This is one suggestion. Second is create a compliance dividend framework. Those who are following better, they should get some advantage, like preferential across the government tenders, faster regulatory approvals across ministries, lower compliances frequency and requirement. And this approach will extend the taxpayer base more effectively than enforcement alone. Because we have seen that if your rating is good, you are getting the tax rate is low. Same thing we want that the tax integrate with the financial ecosystem should also be there, like the credit rating. India should move towards the system where tax compliances strengthen creditworthiness and reduce borrowing costs and enhance investors' confidence. Institutionalization of compliance across the economic system should be there. And this, if you follow and connect with the borrowing cost reduction, I think more and more people will jump to this and they will be part of this ecosystem. Then last point, build a national culture of tax citizenship. In India, the taxpayer list is very less, and we have seen lots of people are earning huge money, but they are not filing return. And that's why the tax is also not collected the way the income and GDP is there. So we have to build a national culture of tax citizenship. We must begin positioning taxpayer not merely as a contributor, but as a partner in national building. If responsible taxpayer feel respected and visible within the system, compliances will grow organically and effectively. At last, this Income Tax Act 2025 is not the end of reforms. It is the beginning of the long transformational journey which we are seeing and which the government is proposing. With that thought, I warmly welcome all my panelists, speaker, and they will take us through this technical, interpretational, and practical dimension of this landmark legislation, which is affecting everybody in India, whether it's a corporate or individual taxpayer, or those who are not paying tax, they are also affected because of different way. So with this thought, I will request Mr. Rajiv Kumar to start this particular things, and because he is in the government, he is a part of this. So what is this law and how this, then our expert will discuss each and every aspects of this. Where is the lacuna? Where is the improvement? Over to you, Mr. Rajiv.
Good afternoon, friends. This is a great opportunity which has been provided to me by Pawan. I just want to tell you that I superannuated from the government about barely a month back. And therefore, my memories of working in the department today is very fresh. I worked in the various, wings of the department, right from the, assessment, investigation, transfer pricing, international taxation, and also I was CITDR at the ITAT. When I joined the service in 1993, we had a very different culture altogether. We were loaded with files. and everything is to be done manually. We uh, used to issue the notice, prepare the blue books, where we used to, write about uh, the name of the SSC, their demands, their everything is to be manual. And now you see the how there has been a paradigm shift in the working of the income tax department, especially in last decade. The mm, the last year the finance minister was speaking at the Vigyan Bhavan, and we in the income tax department had to take a oath on something called prudent. I know you must have heard that word prudent. And prudent P signifies for professionalism. We have seen the IRS officers today are much more, you know, uh, uh, they have changed their, outlook towards the businessman. They are looking everything with, they are professional people and trying to be more technologically driven. They are engaged in enhancing the service quality of the taxpayers. We also have become more responsible to the needs of the taxpayers. R stands for responsibility. We have become very responsive to the needs of the taxpayers. Gone are the days when the uh, CP gram, which is the taxpayer grievances, used to be left alone for 3 months, 4 months, 6 months. Now, the timeline to reduce the CP gram has come down to 21 days. And maybe, in times to come, it will further improve. We are now more keen to the understanding of business transactions, and we have better insights into the business operations. There are a lot of in-house training which is going on in the department, and every IRS officer is today asked to devote certain hours to upgrade their skills. This is, transforming the work culture as well as the knowledge of the IRS officers. Then D is, we are all dedicated officers, and our decisions are based on the data using analytics to guide enforcement. So there is a lot of things, now uh, people who have worked in INCI would tell you that everything today is recorded, and it is thrown to the by the system. We no longer do the selection based on the our old perusal of the files. Now we have everything is technology data driven. Now today our officers also enforcing the tax laws with empathy. We are prioritizing guidance over intimidation. And then we have a non-intrusive tax administration, and which is technology driven. So there has been a lot of changes in the department over a period of time. Now, coming to the main topic, which is the Income Tax Bill 2025. As you all know, this was tabled in the Parliament on 13th February 25. And the whole idea of making this bill was guided by three core principles. They were first simplification, and those three principles were textual and structural simplification. Then There were no major tax policy changes and no modifications of tax rates. So more or less simplification exercises were guided by to make the Income Tax Act more concise, more lucid, and easy to understand for a common graduate. Now, while finalizing, we had formed several groups all across the country, and this is the first act which was prepared in-house. Of course, there were a lot of consultations that I'll come to, but there were three-pronged strategy which was adopted. And these three-pronged strategy was to eliminate intricate language to enhance the readability. Now, second was to remove redundant and repetitive provisions for better navigations. And third was to reorganize sections logically to facilitate ease of references. This three-pronged strategy resulted into a lot of and thereafter there were a lot of consultative and research based approach. There were widespread stakeholder consultations, and as I remember, there were 21,000 suggestions were received in this regard. And there were also, we also studied the simplification process which were carried out in Australia and the UK. And, I just read somewhere that in the Australia, it took almost 4 years for the tax law improvement, whereas in UK tax law, rewrite project was for 14 years. And this is our project is not much more. It didn't take more time than a year and a half, and so this is a better prepared in a shorter time, and we all have seen this act now. And of course, no act can be made without stakeholder consultations, and there will be always improvement of the act over a period of time. It cannot be static, as Vijay Pawan was mentioning, how there can be dynamic changes in the income tax over a period of time. But what happened to the outcome of this simplification exercise? If we just read the quantitative impact, the old act had 5,12,535 words, which got reduced to 2,59,676 words. So there were reductions of 2,52,859 words. Initially, there were 47 chapters in the old act, which became 23 in the new act. There were 819 sections, which got reduced to 536. There were 18 tables. Now, in the new act, there are 57 tables. There were 6 formulae, which increased to 46. There was 11 schedules in the old act, and it got enhanced to 16. So there has been quantitative impact from the earlier act. Why I'm saying earlier act of 1961. Then besides this, there has been qualitative impact as well. What is those are the qualitative impact? There is a simplified language, making the law more readable, accessible. There have been consolidation of amendments. There have been removal of obsolete and redundant provisions for greater clarity. There have been structural rationalization through tables and formulae for improved readability, and there has been presentation of existing taxation principle ensuring continuity while enhancing usability. So there has been a lot of changes in the new act, which has tried to capture the changes which have taken in the last several years. The question always arises, why the new act? So it was answered. Originally, there were 298 sections, but increased to 819, and see new provisions introduced and extensions of existing ones. If you see section, I'm just giving an example. Section 115, it has 100 series, 115 AC, 115 AD, 115 JB, 115 VP, so and so forth. So there were, even the last 60 years plus, there were nearly 4,000 amendments. And every year, there were more than 100 amendments. And there were 19 specific taxation laws amendment bills also. So, so there was a need for change the the act to make it more simple without losing or altering the legal nuances, continuity in taxation principle and tax rates, and grandfathering accrued rights and liabilities, no unintended disruption. So major policy tax rate already carried out in the last 10 years had this much. Now, I have already told you what were the modalities which were we adopted, stakeholder consultation, etc., etc. Now, substantive tax amendments, if a substantive change in law, it was through FA and not simplification bill. For example, there was section which was introduced 72A6B effective 1/4/26, limiting of carry forward of accumulation losses in business organization to 8 years from they were first computed for producers and entity. So there was need for, there were certain terms phrased which were uh, which needed to be changed. Now there is a lot of debate which was going on, which I'll come to, whether the notwithstanding has been replaced by irrespective of. Now, notwithstanding in the old act was there for 400 instances, and this served as a statutory override. Provisions will apply despite anything to the contrary in other conflicting provisions. This interpretive function is preserved in the uh, new act. Even in other countries like UK and Australia, such archaic expressions were generally avoided. And I remember in the speech, the finance minister kept saying that this word notwithstanding needs to be replaced by something else. Of course, there will be a debate on this, whether both phrases are being used to establish the priority of one provision over the another, or in case of conflict, or there is some interpretation, different interpretation, but there is something irrespective of is means without consideration for or regardless of. This linguistic clarity has been introduced, and there can always be debate and there can be a question whether this is a right word or not, but this is what has been introduced in the new act. I've already in the FM speech, which was delivered in July 24, uh, it was stated that the purpose of this comprehensive review was to make the act concise, which I said lucid and easy to read and understand, eliminate redundant provisions. All provisions, 1200, 900 expressions have been removed. And there is, I'll just give you an example. For instance, in the earlier act, it used to be, for instance, clause 2 of clause B of subsection 1 of section 133, which has now been simply written 133 bracket 1 bracket 1 B bracket 2. So earlier it used to be, the involvement of subclause, clause, subsection, and then section. So significant aspect of the bill is to eliminate a lot of things which are redundant and which are repetitive. One of the change which has taken place is about the concept of previous year and assessment year with tax year. There's a unified, the act eliminated the potentially confusing legacy. There were a lot of confusion which was existing previous year, then assessment year. Now they have been replaced by a single unified concept called the tax year, defined as the 12-month financial commencing on the April 1st. Now, this act has also taken into account digital integration and enforcement. The act clearly defines virtual digital assets, including cryptocurrencies and tokenized assets. Virtual digital space, it defines this environment to include email servers, cloud servers, social media, and online trading accounts. Then there is a lot of emphasis now on the faceless assessments, and this act enables faceless assessments and digital compliance to reduce human interface, improve transparency, and minimize corruption, streamline compliances and consolidations. There has been multiple rules related to tax deducted at source, previously scattered across many sections, which are now streamlined and grouped under section 393. Outdated and repetitive provisions, of course, have been identified and removed. There is improved dispute resolution also. The act introduces a robust and tax-friendly framework for resolving disputes aimed at reducing litigations and fostering a trust-based environment. There is a policy continuity, retained principles. While the structure and language are overhauled, the Act preserves the existing taxation principle to ensure certainty, and there is a stable rates. The Act was designed with no major modification to tax rates and ensuring that there is a predictability for the taxpayers. There have been Act embraces contemporary economic realities by defining virtual digital assets such as cryptocurrencies, which I talked about, and virtual digital space. It also enables faceless assessments and digital compliance to reduce human interface, improve transparency, and minimize potential corruption. There's a now by providing greater clarity in legal provisions, the Act empowers business to focus on growth rather than procedure complexities. So this is the the framework in which the new act has been framed. We can go on discussing uh, the what was the old provisions and what is now new provisions, but that I will leave it for some other time. This is what I just wanted to brief about the new tax act, which is going to be operational from 1st of April 2026. Thank you very much.
Thank you, Rajiv ji, for giving the nitty-gritty and the inside of this. And the most important thing, which you mentioned, that the three principal strategy and the main point which was there, eliminating language correction, redundant section removal, repetitive, reorganized section. I think if you can do this also, it is a big change because the law has become so bulky and so unmanageable. And for a small taxpayer or the person even who is expert, to tell him section 1 to 7 subsection this proviso this, it's a total confusion. Even if the law is achieving this, it is a great achievement. And very interesting point which you have said, that 5 lakh 12,000 word has reduced to 259 lakhs. That is also very interesting to read, that yes, by section wise it may not be 50%, but word wide it has reduced to around 50%. So that is very important. So thank you very much for giving insight and how the government has used this particular thing from the regulatory side, that what is our message, what we want to do. That indicates that the government is really serious to do this. Now let's listen to the expert who is daily practicing in this area, and they are facing language problem, they are facing client's interpretation also, and then their own interpretation also. And every year they are speaking on budget, and the focus on budget is that this section has this interpretation, now this has changed this, and now this interpretation has brought this new confusion. So I hope it will be over. So let's listen to RK Agrawal ji. He is doing in this area the strong practicing in so many things. So let's listen to him. RK sir, your turn. Uh, Rakesh bhai, RK's connection is something. So can you start?
Yes. Mhm. Now, Rajiv ji has spoken about the Income Tax Act 2026, but then I have got slightly uh, modified and diluted view on this. Now, when much ado was made by the government that we are bringing a vision document, uh, then that document ought to have been that it boosts the economy. It was to act as a catalyst for the growth, but except by reducing number of words, and that too by removing the redundant provisions, in what manner would it contribute to the national growth? I mean, that is something which is to be seen. Now, much criticism was given to Income Tax Act 1961, that there were 4,000 amendments. And then kindly see that Income Tax Act 2025, before it could see the light of the day, which is to come on 1st April 2026. Approximately 100 amendments or 80 amendments are already proposed in this Finance Bill 2026. But then, be that as it may, let us hope for the best. But then, when the government has said that there is no policy change, the policy which was there in 1961 Act will continue to remain and exist in case of Income Tax Act 2025. Then what was the rationale for making this wholesale disruption? Now that, we could not understand. But then the topic which has been given to me as to what are the changes affecting individual taxpayers. Not much changes are there on substantive basis in the Income Tax Act 2025 insofar as the individuals are concerned. Now, under 1961 Act also, we had got section 115 BAA, now which used to speak of a concessional tax regime for the individual taxpayers. Now the same has been carried in this Income Tax Act 2025 also. The only difference in Income Tax Act 1961, about 2-3 years back, this concessional tax regime uh, with no exemptions or no deductions was not a default scheme. SSE was required to have opted or to have gone in for that kind of a scheme. But now under Income Tax Act 2025, now this has been made as a default tax regime. Though the old tax regime is also in continuation, but then if SSE does not choose or does not give any option to go in for any particular tax regime, then this tax regime will be by way of default, in which there are enhanced basic exemption limit of say rupees 4 lakh, and then there are slabs in multiple of 4 lakhs. So the 4 lakhs nil, 4 lakhs to 8 lakhs 5%, 8 to 12 lakhs 10%, 12 to 16 lakhs 15%, 16 to 20 lakhs 20%, and 20 to 24 lakh 25%, and above 24 lakhs 30%. So, but then the tax rebate now has been enhanced in this new taxation system, which is applicable for individual taxpayer by way of the default tax regime, that 100% tax rebate if the total income does not exceed rupees 12 lakhs and the maximum rebate has been capped, thus is rupees 60,000. So if somebody is earning income of rupees 12 lakhs, then he has not to pay any tax, because 100% of the tax now would be made available to him by way of the tax rebate. But then those who do not want to be governed by this default tax regime, for them the tax rebate will be 12,500 up to the income of the rebate applies to incomes up to rupees 5 lakhs, and the subject to maximum of 12,500. Though there is a concept of marginal relief also, but then that is it. Now, in case of this default tax regime, there is a standard deduction now which has been enhanced to 75,000. It was there in 1961 Act also, but then it was not default tax regime, but now it is default tax regime. 75,000 is standard deduction. And in other cases, in case somebody wants to go in for the old tax regime, then the 50,000 is the highest amount. Now, as Rajiv ji has put that the confusion of the terminology assessment year and previous year, now that is a welcome move, because the previous year used to suggest as if we are talking of a year prior. But now it has been replaced by the tax year, and which has been defined to mean a 12 months financial year period starting from 1st of April. And the income of a tax year is to be taxed as per the rates which are there on the first day of April of the financial year. So the tax year is a period of 12 months commencing from 1st of April. Now, under section 6(1) capital A, if you remember, under the 1961 Act, there was a concept of deemed resident. Now, since there is a no policy change, that policy is being carried forward from earlier law to this law also. So that deemed resident rule now is applicable in the new tax regime also to cover an individual who is an Indian citizen having Indian income exceeding rupees 15 lakhs other than the foreign income, and he will be treated as deemed resident, and if they are not liable to pay tax in any other country due to residence or domicile. So that concept, which was there under section 61A of erstwhile 1961 Act, now that is continuing under 2025 Act also. Now, in respect of the business and corporates, uh, there was section 115 BAB under 1961 Act, and the tax rates were moderated for the corporates and to a substantial extent. Those same rates are applicable in the new tax regime also. 22% is the tax rate for domestic companies, uh, provided they forego certain deductions, because this 22% tax rate is applicable to domestic companies who opting for new regime and foregoing tax exemptions, tax deductions. But then those companies which were set up between 1st October 2019 till 31st March 2024, their tax rate is 15%. But then they should be manufacturing also, and they should be set up within this window period of 1st October 19 and 31st March 2024. For the rest of the companies, the tax rate is 25% of domestic companies which are set up on or after 1st March 2016 and which are engaged in manufacture research. So these tax rates, in case of the in case of the companies, have been made very competitive, and this is very good in that sense, because at one point of time it used to be very hefty. I remember when we were doing our graduation, the tax rates on the corporates used to be very hefty, but then slowly and gradually they were moderated, and for a number of years, for a long period, they remained static at 30%, but then it has been brought down again to 22%, 15%, 25%, depending upon in which category one falls. Now, regarding the TDS provisions, as Rajiv ji has said, that earlier the TDS or TCS provisions were scattered under various provisions of the Income Tax Act, but now they have been streamlined and brought under Section 393, and schedules and tables now have found place. This is the uniqueness of Income Tax Act 2026, that the schedules and tables now have been given under Income Tax Act, in the act itself, so as to make a very lucid and a very sequential and logical presentation. Now, presumptive taxation scheme. Now that is also continuing with same thresholds and same conditionalities. The turnover limit for the presumptive business is increased to rupees 3 crores. It was made under 1961 Act also. 3 crores, provided the cash receipts do not exceed 5% of the total turnover. And in case of the professionals, the gross receipt limit is increased to 75 lakhs, provided the cash receipts are less than 5%. So this presumptive tax scheme now has remained same, which was there in 1961 Act, and it is same. Now, faceless and digital compliance, faceless assessments or facelessness of the proceedings has been the thrust which this government has given, and that thrust is a little more in 2025 Act, though it was in abundance in 1961 Act. Since last several years, we had been watching that most of the assessments are being done in faceless manner. And this is the endeavor of the government to bring more and more proceedings in a faceless manner, so that there may be transparency, there may be lesser incidence of any malice or allegations of bias or other extraneous considerations. Now, regarding the audits also, A person's carrying on business is required to get his accounts audited, provided his turnover exceeds 1 crore of rupees. But then this limit of 1 crore becomes 10 crores if his transactions in cash, both on receipt and payment account, do not exceed 5%. Now, as Rajiv ji has pointed out, taxation of digital assets, also virtual digital assets. In case of search also, the concept of virtual digital assets uh, and virtual digital assets have come apart from money, bullion, jewelry, valuable article or things. Now, in non-profit organization sector, reforms have been introduced in a very big way. And this is something which I find very useful in Income Tax Act 2025. Earlier, if you remember, in 1961 Act, there were two parallel regimes under Section 11 and under Section 1023C. And there were provisos and explanations and provisos to explanations. This entire concept of the taxation of charitable trusts itself was highly uncharitable. Now, under Income Tax Act 2025, this registered non-profit organizations concept has brought a very cohesive legislative framework. And that framework is that there is a, first of all, unified term. Now, in 1961 Act, we had got trust, institutions, hospitals, educational institutions, societies, different terminologies. But now unified terminology has been accorded under Income Tax Act 2025. I mean, to be called as non-profit organizations. This unified terminology now is very good as compared to the erstwhile multifarious terms which used to be used. Now, cohesive legislation framework, as I said, that the entire scheme of assessment of the non-profit organizations has been dissected into 7 chapters. First of all, registration, then the income, then the commercial activities, then the compliances, then the violations, then again approval for ATG, corresponding provisions 133 subsection 1 clause B2, and then last interpretations in section 355. So all those terminologies which have been used in this chapter, now they have come to be defined in section 355 under the caption of interpretations. So this legislative framework, which has been made very cohesive for the registered non-profit organizations, is very welcome step in 2025 Act. Now, eligible persons. Now, who can make applications seeking registration now has been exhaustively mentioned, like trust societies, Section 8 companies, Section 25 companies, then educational institutions, university, so on and so forth. And all those entities have been exhaustively listed as to who can go in for registration. Then in registered non-profit organizations taxability, tables have been used extensively. And those tables make a very lucid presentation as to which is the situation, now who is required to apply, within how much time is required to apply, PCIT is required to dispose that application within how much period, and then the registration, if allowed, will remain for how much time. Now, one more thing which I would also like to have a quick, because maybe Raji also would like to share on a very important concession which has been given by this finance bill by making amendment in Income Tax Act 2025. And that is, if though this terminology has not been used in this proposed amendment VDIS, but then this kind of a disclosure methodology now is proposed to be inserted in the sense that if an SSE introduces his funds, say in the bank account, which he is not able to explain from the income tax point of view, then he can make payment of tax by including that amount in his income tax return. And on that, there will not be any penalty. If you remember under 1961 Act, if there was any income, if the SSE used to offer even on his own in the return of income, which was from an unexplained source, then apart from the levy of tax at 30%, he was required to be visited with he was required to be not 30%, 115 BBE tax rate was 60%, and that 60% was not mere 60%. It was to be loaded by 25% of 60%, that is 15% a surcharge, and then 3% of the education cess. So effective tax rate was already 78%, and there was a penalty under section 271 AAC, which was equal to 10% of 60%, that is 6%. So the overall tax effect used to come at 84%. Now, after this proposed amendment in section 195 of Income Tax Act 2025, if an SSE declared some income, even if it is from undisclosed source, then he can pay tax to the extent of 30% by including it in his return of income, and there is no penalty or there is no enhanced tax rate which used to be there earlier. But let this finance bill proposal be passed by the parliament and let it become an act. Only then the final position will be there. But then, insofar as the proposal is concerned, this is a very, very good concession which is sought to be given through this finance bill by making an appropriate amendment to Income Tax Act 2025. So, Pavanji, I would give quietus to my deliberation at this stage. Thank you for inviting me to be with all of you.
Thank you, Rakesh Bhai. The most important thing relating to various laws you have explained, but the most important thing is we were going to listen Nani Palkhiwala on budget speech every year when he was alive, and whatever he was talking, we were listening, we were mesmerized. But the most important thing which we were mesmerized was he was explaining section, subsection, proviso. And I think the same way you are also explaining the section, subsection, and then para. And it's a art actually to remember everything and immediately recollecting this or immediately connecting to that particular thing. It's a God gift. So thank you very much for giving insight of this and suggesting what are the good point has come and what are the issues which we will discuss later on. So over to you, R.K. Agrawal ji. Rakesh has mentioned, Rajiv ji has mentioned the point how this has happened. Now your turn. I remember when the budget came and this issue was also coming, you mentioned that there are so many things government could have changed this and improved this. Over to you.
Thank you, Pavanji. In fact, Rajiv ji and Rakesh ji have already deliberated in detail what kind of changes have been made in Income Tax Act 2025, which is effective with effect from 1st of April 2026. If I just go back to the intention and the desire of the government to make Income Tax Act easy, rational, and simplify, the attempt have been made so many times during last 25 years. I remember 1997, Direct Tax Code 1 was tabled in the parliament and it was made open for public comments. There were so many suggestions, including a lot of criticize of some of the provisions which were there, that Tax Code 1 could never be enacted. Then another attempt was made in 2007-8 when Direct Tax Code 2 was introduced. again the same fate happened to that also, because there were two objectives of the government in the earlier attempts. One was to simplify the act, language and understanding, so that the people can understand it easily, make it more lucid. And second attempt was to make wholesome changes in the provisions of the act, so as to make it more user friendly, more rational, more tax friendly. In fact, when the provisions were substantially amended, there was a lot of criticize this way or that way, in affirmative also, in negative also. But and these courts were opened for the public comments. So comments were so much that government could not take the courage to enact those two the new act in those earlier two attempts. So this time they thought that we should try to achieve one objective, not both the objectives simultaneously. So one objective regarding the simplification of the language, make it more lucid, readers friendly. So now this 2025 Act was enacted with this intention. No changes at all were made in the substantive provisions of the Act. All the provisions which were in 1961 Act were kept in the same manner in 2025 Act. And there was another reason for this, because during last 25 years, from 1998 till 2024-25, lot of amendments which were intended to be made by the government in the Direct Tax Code 1 or Direct Tax Code 2, those were already enacted by making the amendment through union budget every year. Therefore, also they thought that now very few things have been left, which will be taken care of later on. And the first opportunity which came to the government after enactment of 2025 Act was the Finance Bill 2026, Union Budget 2026. And we have seen that even when the 2025 Act has not been put to operation, it is effective from 1st of April 2026. Still, lot of amendments have been proposed, which will be enacted as soon as the budget is passed by the Parliament in the month of March itself. So therefore, the intention of the government is now that let us simplify the language, which has been done, as already explained by the previous speakers. And substantive amendments we will keep on making on year-to-year basis. And I will say that this year's budget, 2026 budget, union budget, where amendments have been proposed in 2025 Act, I mean, the amendments have been made with a lot of wisdom, lot of conviction, and with the lot of clarity, which used to be missed in earlier attempts sometimes. I will just explain some of the changes which have been made, because the substantive amendments which have been proposed and 2025 Act will get amended. And when it will be put to operation from 1st April 2026, that is the tax year now 26-27, then these all amendments will be in effect. Buyback of the shares, I mean, the provision which was made last year was so cumbersome, so impractical. It has been now changed. I am not discussing in detail the amendments which have been made, because there have been a lot of programs earlier where the amendments which have been made by the Union Budget 2026 have already been discussed. I am just pointing out that what kind of amendments government has introduced, and the intention of the government. There are two major objectives by making the amendments, proposed amendments in 2026 union budget, that to reduce the litigation, and second, to give an opportunity to the taxpayers to settle the tax evasion by paying the taxes without attraction of penalty and prosecution. And they have been very successfully, keeping in mind a very practical approach. They have tried to do it. Let me just tell you that now, first of all, the two major things which have been done. First of all, prosecution provision have been made almost toothless. Decriminalization of the prosecution, which the provisions which have been brought in this Union Budget 2026, which would be incorporated in the Income Tax Act 2025. These are really salutary. What they have done, that the rigorous imprisonment up to 7 years has been reduced to simple imprisonment up to 3 years in all the provisions, irrespective of the kind of offense. The maximum is now 3 years. Rather, in most of the provisions, it is only 2 years, 6 months to 2 years. The impact of which is that it becomes a bailable offense. If the prosecution sentence is up to 3 years only, then it becomes a bailable offense. When it is bailable offense, then the rigors of the provision or the sword of the prosecution, the criminal offense which used to remain, has been made almost toothless. So this is one very major objective which government has taken, very bold step which the government has taken. And secondly, you see, at every stage, now they have given the opportunity to the assessees to come forward. If there is tax evasion, then pay the taxes, settle the issue, no penalty, no prosecution. Right? At 4 stages, they have done it. First of all, when you file your tax return, if there is any income source of which cannot be explained, generally if there is tax evasion, then you might have earned the income, but you cannot tell the source of the income, which are called the deemed incomes under section 68, 69 of the Income Tax Act 1961 and corresponding provisions in the 2025 Act as well. So there used to be, as Rakeshji also told, section 115 BBE, where the tax rate was 60% plus 15% plus 3% cess, going up to 78%, and then penalty also up to 10%. So it was such a huge amount that generally people were not availing to make the declaration, or if the additions were used to be made by the assessing officer, then the rate of tax being attracted was quite heavy. But now this section has been amended, and the rate of tax would be the maximum marginal rate, which is 39% only, without any. So if you make declaration, you can make declaration yourself of any income, source of which cannot be traced, source of which cannot be explained, means where tax evasion was involved, one can say. In that case, you make the declaration in your tax return, even if you are having the cash, source of which is not explained. Generally, when searches or surveys take place, there may be cash or undisclosed investment in jewelry or in buildings or in some other assets which are found. So you make declaration in the tax return, in the income tax return to be filed. In that case, only maximum marginal rate of tax is required to be paid. So first opportunity is, while filing the regular tax returns, you can make the declaration and settle the issue. There will not be attraction of any penalty or prosecution. Second stage, you have filed the return, and after filing the return, you find that something has been left, something has been evaded, which has not been declared in the tax return. There is the opportunity to file updated tax return. Updated tax return provisions came 4-5 years back, and now up to 4 years you can update your return by paying extra tax, additional tax on the amount of tax which has not been paid earlier, for which income, additional income is being declared now. First, if it is done within 12 months or within 1 year, then 25% additional tax. Within 2 years, then 50% additional tax. Within 3 years, then 60% additional tax. And if it is up to 4 years, then 70%. So up to 4 years and 1 year, the time for which is given for filing the return. So practically, after the end of the tax year, up to 5 years, one can update the return. If any evasion of tax or any income on which is found not to have been declared in the tax return, second opportunity. And again, no penalty, no prosecution. You get, I mean, there is inbuilt settlement scheme which have been provided in number of provisions in the Act now. Third, when you don't declare yourself, department or income tax department detects and issue you notice under section 140A for reopening of the case. You get the notice, you get the order that there is income which has escaped assessment and we want to reopen your case, for which you are again asked to file the return of income. Earlier, the provision was that if you declare, then apart from the tax, penalty and prosecution could also be attracted. But now they have amended the provision that even after the notice under section 148 is issued, you can, while filing the return of income, you can yet make the declaration of your income by paying some additional tax, maybe around 50% of the tax probably, if Rakesh can correct me. You can make the declaration. Again, another opportunity, when department has detected, issued you regular notice. Even then you can make the declaration. No penalty, no prosecution. And fourth opportunity, when search takes place, the extreme action which department could have taken, search has taken place. During search, tax evasion has been found. It has been detected. There are undisclosed investment. There are undisclosed income. You again get the opportunity while filing the return of the block assessment of the search year. There you make the declaration by making the payment of 60% of the income without any interest, without any penalty, without any prosecution. Here, even interest is not required to be paid. Only 60% of the amount of income which has escaped assessment or which has been detected by the department is required to be paid. No penalty, no prosecution, no interest. I mean, you see, this kind of practicality, this kind of pragmatism, which has been shown by the department in the provisions or in the amendments during this year and even earlier 1 or 2 years, it is exemplary. I mean, never this kind of practical approach was never imagined in the earlier mindset of the department. So department is really turning taxpayer friendly, but it is now for us to how to avail the opportunity. Another provision, MAT provision, because government want that everybody should shift from the old regime to tax regime, to new tax regime. For corporates, old tax regime is attracting rate of tax of 25% and 30%, along with certain exemptions under section 10 or under section 80. But new tax regime, which Rakesh ji also discussed, is asking only to pay 22% tax plus surcharge, etc. Effectively 25% of tax, but most of the deductions, exemptions cannot be claimed. And government want the Income Tax Act should not be used to claim the exemptions and deductions of various natures unless government want and prioritize further keeping in view the overall objective of the economic growth of the country. Then in that case, also when this tax is to be paid, corporate tax is to be paid 25% only, then new tax regime they want people to shift. But there was a hurdle that people were not shifting, that MAT credit was lying with a lot of people. And due to MAT credit, in the new tax regime, MAT credit could not be carried forward, could not be taken credit of. Only on old tax regime, credit of MAT credit could have been taken. Therefore, people are not shifting. So they have made the provision that if you shift to the new tax regime of 22%, the MAT credit which is lying unavailed would be allowed to be set off against the tax liability up to 25% of your tax liability. Again, a very, very welcome step. I mean, the intention is clear that you come forward and avail the new tax regime, which is more beneficial and more taxpayers friendly. And government does not want that two tax regimes remain, so that unnecessarily, I mean, administrative problems are also there. Then, for reducing the litigation, so many steps have been taken in this union budget. There was one provision, payment of employees' contribution of PF and ESI. Even if there is 1 day delay from the date which is allowed to be paid under the PF and ESI Act, then the amount of the employees' contribution, entire amount, was not allowed as a deduction under the Income Tax Act. Even on payment basis, it was not allowed. So there was so much of litigation pending on this issue, even up to Supreme Court. The decisions were against the assessees, and a lot of litigation was pending. Government again has eased the provision. They have said that no, if even employees' contribution is delayed up to the and if it is paid up to the filing of the tax return, like the employer's contribution, it will also be allowed as a deduction. There will not be any disallowance on this account. Apart from this, there were 3-4 major issues on which litigation was going on. Jao Fao was there, some transfer pricing cases were there. I mean, due to certain technical problem or some delay in the issue of the notice, etc., a lot of litigation was pending. Thousands of cases were pending with the High Courts and Supreme Courts. Government has made the amendment this way or that way in such a manner that uncertainty goes. Either there is, I mean, there is relief to the assessee or relief to the department, but clarity is there. It is not the point that who gets the benefit. The point is uncertainty should not remain there. So litigation is reduced. So this year, I mean, a lot of provisions have been made with the intention that litigation is reduced. Another thing that we are talking of new tax regime. Government brought new tax regime where hardly there are any deductions or exemptions which were there under Section 10 or under Section 80. Maybe for setting up your unit in the backward area or in SEZs or for housing societies, etc. There were different provisions where deductions were there. Almost in all the cases, sunset clauses were already introduced. Therefore, in the new era or in the future periods, these deductions were not available. But since initially these deductions for 10 years or 15 years, for the people who have already availed these deductions, these were being carried on. So the intention of the government was that there should be some closure, some of these deductions, exemptions, so that people shift to the new tax regime. So with this intention, government has brought the new tax regime, that Income Tax Act should not be used for the purpose of giving the tax exemption or deductions for channelizing the resources in the desired channel. That was the thinking to make the changes by bringing the new tax regime for the corporates and even for the individuals. Now for the individuals also, I mean, deduction under Section 80C, which used to be there, are no more there. So the idea was that Income Tax Act should be where no exemption deductions are minimized, and you pay the rate of tax were reduced, and you pay the tax. And if you want to avail these kind of deductions, exemptions, these are not available in the new tax regime. But the priorities of the government keep on changing. With the passage of time, there may be certain more attractive requirement for the purpose of the overall economic growth, that certain deductions are further introduced in the Income Tax Act. So even in the new tax regime, slowly every year or every 2 years, some or other deduction or exemption is now again being introduced. This year, for establishing data center, by bringing the foreign capital, they have given the exemption tax holiday up to 1947. Such a long term thinking. When हम विकसित भारत की बात कर रहे हैं तो 47 की बात कर रहे हैं, and data center is now the most priority item to be set up. So to bring the investment, foreign investment, for establishing data center for the purpose of use of AI, or which may be the need of the future. Again, government has introduced this kind of deduction exemption, this kind of exemption in the Income Tax Act, even 2025. So the point is that substantive provision of the Act, though in 2025 Act, were not made at all, but gradually these are being made through the Finance Act. This year they have made a lot of changes, and I expect that in future years further amendments which are required. At least I can point out some 3-4 provisions which require really amendment, which are not quite cumbersome, which are not clear and matching with the objective of the government or the objective of the direct tax. Like the just few examples, the taxation of partnership firm. For in the case of restructuring of partnership firm, the provision presently is quite cumbersome, and maybe that very quite unclear. It needs amendment. Then Rakesh ji talked about the NPO taxation. When Direct Tax Code 1 came, there was a provision that all NPOs will be required to pay tax. Presently, under Section 12, if they are registered and 85% of the receipts are applied for charitable purpose, there is no tax. But in Direct Tax Code 1, there was a very good provision that after giving full deduction of the capital expenditure, if still there is surplus, they were required to pay 50% of the maximum margin rate. Means at that time it was 30%. So 50% tax was required to be paid by every NPO. I personally feel this was a very good provision, that you give deduction of the entire capex which has been made, capital expenditure which has been incurred, and after that also, if there is surplus of the income, then some contribution by NPOs should be made to the exchequer. Why? To make them totally tax free. Maybe in course of time this provision may also be introduced, but presently no such provision is there. But in Direct Tax Code 1, if you see, this provision was there. Then another thing which I say a number of times, that donation which has been received by the religious organizations for religious purpose can be applied only for religious purposes. It cannot be applied for charitable purposes. Again, I feel that for the purpose of making the at least education and medical facilities quite affordable, if some kind of provision is brought in the Income Tax Act where the donations received for religious purposes are allowed to be applied for the purpose of education and medical, then it can serve a very good purpose for the society, for providing the free education or concessional education to the needy and unprivileged section of the society. This is another provision amendment which I do expect from the government. Another thing can be for some provision for the capital formation, because the biggest need for the economic growth is the private investment, to boost the private investment, which is still lacking. We are too much dependent upon the foreign investment for the growth of the economy. The private investment which is required to be boosted, for this, one thing is to create the trust, to make the provisions taxpayer friendly, which government is making the attempt, and a lot of attempts have been made, as I discussed. And second thing, that they should make some tax incentive so that capital formation may be there by the private capital formation may be increased. Another thing which comes to my mind is investigation process. A lot of amendments have been made for the purpose of faceless appeals, faceless assessments, but investigation process is still in the same manner. One suggestion which I give, that all investigation proceedings should be under camera. This may bring a lot of transparency and fairness in the investigation process. Maybe that in course of time, this is that I'm just pointing out that what was in the mind of the legislature or in the mind of the lawmakers. A lot of things have been done in this year. Still, some things, some provisions are still remaining. I have just given the example of 4-5 things, which may also be introduced in course of time. Then this act becomes really, I mean, language is one part, but the provisions to be taxpayer friendly, which are good for the economic growth of the country. The ultimate objective of everything is growth of the economic growth of the country. So those kind of provisions are also expected to be introduced. Apart from this, so far as the new Income Tax Act 2025 has been introduced, old law will also remain there. The cases up to 31st March 2026 will be governed by the old provisions. So therefore, 1961 Act for the assessment year 26-27 up to this, if there are any assessments, appeals, or any notices which are to be issued, if these are if those for those proceedings, the provisions of old act will remain. Even in this year's budget, certain amendments have been made even in old act also, because the old cases will remain and those will be settled as per the provisions of the old act. New act would be applicable only from 1st April 2026 onwards. Whatever the carry forward of losses or credits in the MAT, etc., or any exemptions or deductions for which sunset clause or the period has not expired, all those will be carried, and this will be honored even with the new act also. So I think these are the major amendments, or this is the major objective of the new act, with which, with the intention with which it has been brought. And I think that government has done the salutary job, salutary mindset which has been shown, which has been displayed by making such kind of amendments and such kind of approach in the amendments which have been brought by the Union Budget 2026 and the Income Tax Act 2025. With this, I close my deliberation. If there are any questions, then we will discuss. Thank you, everybody.
Thank you, R.K. Agarwal ji, for giving detailed explanation and the deep knowledge which you have gained through your experience. It's reflecting within 20 minutes of your discussion with this. Thank you very much. Now, friends, it's a time for question answer. I got a message from Griji. He's still in the meeting. So he's saying, if I come, I'll join. Okay, so let's start question answer session. So, sir, I will start, Rakesh bhai, from you. It is mandatory for the trust whose income was exempted under Income Tax Act 61 to apply again and obtain fresh exemption as a not-for-profit entity under the provision of IT Act 2025?
No, if it has applied earlier under 1961 Act and that period is continuing, then after the expiry of that period, then it will have to apply.
Okay. R.K. Agarwal ji, what about delay payment of PF, ESI on which assessment completed, appeal pending for earlier years? Any relief for those cases?
No, for those cases, there will not be any relief because the amendment is proposed only under the Income Tax Act 2025. The cases which are pending under Income Tax Act 1961. So this amendment which is proposed is prospective, not retrospective.
Okay. RK, you want to say anything on this?
No, Rakesh ji has already explained. But since the prospective amendment has been made, the view of the courts for the earlier assessments may be influenced, or they may take a pragmatic view while explaining or while giving the relief. Because a lot of cases of employees' contribution to PF and DSI are pending with the Supreme Court. Then there may be that now the courts may also have different view which they were not taking earlier.
Okay. Rajiv ji, there is a one question on faceless system are designed to build trust. RK and Rakesh bhai, you can also give answer. Faceless system are designed to build trust. In reality, do you think they will reduce dispute or simply change their nature?
Yes, faceless scheme of assessment now practically is proving very useful in the sense that because of the interface with the tax department, objectivity and fairness, impartiality, and that allegation of extraneous considerations kind of things, they are quite less.
Okay. Rajiv ji, your
Can
view.
I add to this? Can I add to
Yes,
this?
yes.
Yeah. This faceless regime has been done with certain objectives, and those objectives are that interface between the taxpayers and the tax officials to be reduced over a period of time. Now the question arises is that whether is it serving the purpose that it was meant for? If you see from the perspective of interface, yes, there is no interface. But then, there are voluminous records which are uploaded by the taxpayers. And sometimes, we come to know, or we've seen also that unnecessarily, there are sometimes even some emails pertaining to something else are also uploaded. So, and there will be quite a few instances where there have been high-paced assessments because of non-application of mind by both the taxpayers and the tax officials. So, over a period of time, what has happened is that there are a lot of high-paced assessments. Then there are cases which have also been done ex parte. So those ex parte orders, now in the earlier act, it was power given to this CIT appeal to set aside those cases. So, the litigations, the whole idea of the entire process was to reduce the litigation, become more tax friendly, and therefore, there can be questions on this aspect. So, one has to keep in mind the whether it is serving the desired objective or not. So,
Yes, Pawan, may I also add something
Yeah,
to this?
please.
Yes, I feel that the objective with which the faceless system of assessments and appeals was introduced by the government is very pious objective. And the intention is that cases are done on merit without any other consideration. And from my experience of practice, I can say during last 3-4 years, when faceless assessments, because I am dealing with faceless assessments, were introduced, in 80-90% of the cases, we have got excellent orders. The only thing is that the representation should be very effective and in such a manner that the assessing officer or the assessing unit can appreciate your viewpoint in proper manner. As Rajivji said, that sometimes the evidences may be quite voluminous, but if you can summarize them in or can give the executive summary along with the all voluminous material, it can lead to a better representation and the facts can be appreciated, or the issue can be appreciated in a better manner by the assessing units, assessing officers. But I mean, the intention is very good. The result is also largely, to as per my experience, is good. In CIT appeal cases, it is not much. It is not getting that effective, because I mean, the kind of representation from both the parties are required, may not be there in the faceless manner. But in assessments, I have found excellent results, and there may be certain problems which are in implementation, from the point of view of the assessees also, from the point of view of the officers also. Sometimes there may be certain interest, due to which both of them may not be willing to come forward and get the things done in a faceless manner. But nevertheless, the government has done excellent job, and we all should try to make this regime, this new approach successful.
This is a very serious question which I'm asking. I came to know that this faceless is no doubt, all three speakers are saying it's excellent and it has happened and it is going very well also. But some of the people, they have cracked that system also. That
Every good thing, I mean, may not ensure the goodness for all times to come for all the people. So, but then these are the aberrations, and for certain aberrations, thing the good things should not be
got it.
shunned.
Got your point. Rakeshji, if you look ahead 5 years, what single structural impact of this act will refine tax advisory and business strategy in India?
No, I find even the AI would take away everything that advice.
Okay.
So the use of AI at all levels now, whether would prove a boon or bane, and it is in the womb of time. And but then, as Raji has said, and as Rajiv has said, the things have been made simpler, and the intention of the government is to make further simpler. So I think, but nonetheless, it's a revenue laws, and by virtue of these revenue laws, by virtue of the inherent character of the taxpayers not to pay the legitimate taxes, howsoever lower the tax rates may be. So there will always be, and for you and for us, those who are into advisory and litigations, I mean, we need not to bother.
Because today there is a one very important change also, Rakeshji and Rajji and Rajivji. Previously, people were not paying tax and their return become so negligible. And today, when they are going for big business and everybody asking what is your return, and if it is return is not matching with your profile and with your uh, transaction, then people they don't faith you, and there's a first.
Pawan ji, ये तो सही है.
Pawan,
Now people want to pay taxes.
Yes,
Now people want to pay taxes.
yes, yeah, Rajiv.
see, there are a lot of things which are now technology and data driven. See, a lot of things which are thrown to the department, uh, that those data which tries to match your return. So at times there are a lot of mismatch of data, and then you land up in under scrutiny. So now the people have realized, we have realized, use the technology to a far greater extent, but there are good and bad things about the using of technology. So now people who are using the technology will not be able to get out of this tax burden, or whatsoever you may call. But at times we'll all have to file our correct returns. So the undisclosed income, and the government has simplified the provisions for uh, search cases, or even 68, and all these provisions have been so much simplified. If people start taking advantages of those changes, of course there will be more compliance, but zero uh, nahi hoga. I mean, this
Okay.
will have a lot more years to move before we the zero evasion.
Okay, Raji.
Yes, Pavanji, I would like to add that the thinking that the payment of taxes is in the interest of the government only. We are paying to the government. I mean, it is not only this. Rather, payment of taxes is in the interest of the taxpayers, is the interest of the tax assessees. Because if you want to do business, you want to invest in equity, you want capital formation, the way is that you will have to pay taxes and create the seed capital, create the equity for this purpose. So if you want to grow, payment of taxes by bringing the capital into the business, you can drive so much of valuation. You are the person of valuation. You know it better. You can drive so much of valuation. You must drive so much of growth, which by evading the taxes and keeping the ideal money in some ideal assets, you cannot. So the mindset of the taxpayers is also changing. We are just realizing, and now taxes are so moderate. Can you expect that corporate tax only 15%? What can be a better than this? Corporate tax only 22%. If you pay this much of tax, then the balance amount is brought into the capital formation, and by which the kind of growth you can derive. I mean, there is no other way to. It is in your interest, not that you are doing something favor to the government. You are doing favor to yourself.
Absolutely
Right.
right.
Well,
Absolutely.
very right.
Yeah. Rakesh sir, just tell me, do you think that tax planning will shift from year-end optimism to real-time strategy modeling? Because every time we think, okay, new budget will come, we'll make a tax planning. Now it is continuously real-time strategy you have to work out.
No, but then for planning those exemptions and deductions now have already, most of them have gone. So there is not much scope. But then even whatever scope is there, and if somebody wants to plan it, with the changes which are made in consonance with the provisions of law, then that can be done and that should be done. But then it should not be tax evasion or tax avoidance.
Okay. Okay. Uh, Rajiv ji, how do you see risk-based enforcement evolving under the new framework? Because one is that you treat everybody together, or one is that you are identified this is the main important issue where the tax leakage is there. So risk-based, what is your view and what will happen? You unmute yourself, please.
The risk based parameters are changing every year when the selection of the cases are concerned. So those parameters uh, have been, made. It has not been made public, because the taxpayers are not today aware that if you say deposit 10 lakhs and above in cash in your bank accounts, it gets picked up for scrutiny. Similarly, if you have had property where you have bought that property above certain threshold, you are under scrutiny. Similarly, like, if you have uh, claimed refunds exceeding certain amounts, so the risk based assessments are always, but then percentage of cases which are picked up for scrutiny is very less than 1%. So people are, get some of the people are, indulging in those risk, and they are getting scot free, but some of them are not. So the chances of this model to be succeeded is quite, is 50-50%. So you cannot say that over a period of time you will keep making mistakes and will not get caught. Once you get caught, then the chances of, the repercussion and chances of further payments of additional taxes as per the new act is quite high. So it is in the interest of the taxpayers to, follow those rules and minimize that. Risk-based assessments are, now with AI and algorithms and things like that, the chances of we getting picked up for scrutiny will be very, very high. And the department is now adopting lots of AI based technology, data driven, where the chances are that we'll get those cases scrutinized. So the chances over a period of time will increase rather than go the other way.
Okay.
Yes,
Okay,
Pavanji, I just want to say that with the use of AI and technology, now lot of information of the financial transactions is available with the government. It is coming from the different sources. But how to make use of it for widening the tax base and for catching the people who are not declaring the income in the returns, this system is yet to be eh, evolved or yet to be sharpened, so that the kind of which you are saying, the risk based assessments are made, and those who are not declaring the income are caught into the net. That system is yet to be developed or yet to be sharpened in course of time, which will be done uh, again by the use of technology.
okay. RK ji, आपसे, in your experience, where should taxpayer be most cautious in first 2 years of implementation? If you advise to one big client, what single preparatory step would you provide or prioritize?
Pavanji, as we have discussed, that there are hardly any substantive amendments which are different from the earlier act in the new act of 2025. Therefore, there is no structural change or no conceptual change required to be made by the corporates or by any other taxpayer. The only thing is that now the time has come that one should not try to evade the taxes, or to, I mean, if they can do the tax planning by legal means, by taking the benefit of the provisions which are in the act, it is fine. But not declaring the income or to evade the taxes by unfair means, I think now it is not required, and it is neither in their interest nor in the interest of the overall growth of the country.
Okay. Rakesh ji, do you believe that this law moves India closer to principle-based tax system like global jurisdiction, or does it still remain rule-based?
Well, it's a rule based. It's rule based because, as Raji has said, there are no structural changes. There is no policy change. Therefore, all these questions in the context of this new Income Tax Act 2025 um, do not hold water.
Okay. Rajiv ji, uh, you have worked in the department and you have seen the use of AI will help, you have suggested. But do you think the use of AI can reduce this tax dispute or the procedural part or very other things? Like you said, that people are giving bundles of information, and then these are the issues. So some AI will change certain things, though it is not, because now more simplification law is there, reduced sections are there, interpretation they have tried to modify. So AI will help.
See, there are two part of it. Whether first is this new act. The new act, the purpose is to reduce the litigation. So litigations, how do the litigations arise? We have to understand that there are always, there is a sometimes thin line of demarcation between the tax planning and the tax evasion, and there are a lot of interpretations which happen. Now disputes over a period of time have got settled, but the department uh, has not settled those disputes through AI, and through AI the impact of I would rather say the impact would further increase than decrease, because there will be a lot of information which will be there at the doorsteps of the department, and there will always be, some kind of interpretations on those. Now the point I'm trying to make is that though we have not used the AI in the income tax department as of now, but over a period of time when we use those departments, obviously more cases will be picked up for scrutiny and the litigations are going to go further. Of course, there are a lot of issues which the government is trying to settle. For instance, we are coming out with the VDI scheme, and there are a lot of now emphasis on litigation management. Though every CIT appeal has been given an 60 cases, 70 cases per month task to, finalize those cases. So there are a lot of emphasis on, because there are a lot of demand and disputes right now, which is, with the CAG and the government and everyone is after that. Why such demands are lying there and it is not being collected, it is uncollectible. So there are a lot of emphasis on litigation management, but with AI, I don't think it is going to come down. It will rather increase over a period of time.
Rakesh ji, why income tax is forcing to file return with new tax regime in case someone fails to file on return in 2023-24?
I could not follow your question.
Why income tax is forcing to file return with new tax regime in case someone fails to file the return in financial year 2023-24?
Updated returns you're talking about.
No, I think he's talking of the new tax regime.
Yeah.
Why the income tax department is forcing everybody to go in for the new tax regime
Okay.
by way of default. Yes, I mean that is what the law has been made like this. Yes, you have to follow.
Okay.
Because
Either you
Pavanji,
follow the new law.
Because deductions and exemptions, I mean, the government does not want that Income Tax Act is used as a fiscal tool. So they want this is Income Tax Act is to mobilize resources for the country.
Okay. So I think this is time to close. We have discussed various things, and Rakesh ji, R.K. Agrawal ji, and Rajiv has given insight of the entire subject and what is present. So before closing the session, I just want to take 30 to 40 seconds of every speaker to tell us about what is their take on this particular law and what they want to communicate to the professional or the industry on everybody. Starting with Rakesh sir.
My take is that given the moderations in tax laws and adverse consequences, moderation and adverse consequences, I mean, one should go in for tax compliance to the maximum possible and take advantage of the capital formations out of your income, post tax paid income.
Okay. Rajiv ji, your point. What you want to give suggestions and
see, this is the first time I have attended such program, and to tell you frankly, there are a lot of awareness program which is being conducted by the professionals, by the media, by the government, by the income tax department. In fact, I'll just like to point out that very soon the finance minister is going to open a discussion on the new tax where thereafter the income tax department is going to educate the people about the new tax act. So over a period of time, might takeaway for these kind of program is, you know discussions always with stakeholders, with the taxpayers, with the policy formulators. It enhances your knowledge, and then it also helps to reduce the litigation over a period of time when you advise correctly to the taxpayer that there are certain gray areas where you cannot escape. So these are the ongoing process, and the new tax act which is going to be introduced, there will be simultaneously two acts which will be running parallelly, and there will be a lot of confusion amongst the taxpayers, amongst the professionals, amongst the IRS officers. So we are going to have a much tougher time. So we all need to, my takeaway is to educate as much as possible to the taxpayers and the department and to the professionals. So it is very progressive steps that you people have taken to educate the taxpayers and the professionals. And such programs should keep happening over a period of time, so as to we are afreshed by the new tax laws, etc., and their interpretations. So it is a good platform to work at.
Thank you, Rajiv ji. Thank you, Rakesh ji and Rajkumar ji. Rajkumar ji got some technical problems, so he got disconnected. So the message is clear and loud. The Income Tax Act 2025 is not the end of the reforms. It's a beginning of the long transformation journey, which we will see. And now, if you add AI into this, then you can realize, and the ecosystem, which Rakesh ji and everybody has said, that today capital formation is the most important thing. If you have capital, you can multiply capital. If you have cash, you can't multiply, and you will be always be under scrutiny and under the fear. So the time has come that people should realize that ऊपर वाला सब देख रहा है. So something
AI dekh
is
raha hai.
watching. AI is watching you. Whatever you are spending, wherever you are traveling, if it is not matching with your income tax return, it can come. And I will tell you, because I was before this program, I was studying Rakesh Bhai, the latest war which is taking place. And you have heard this topic also, that AI is using in this war. And what they are doing, all earlier war data, all earlier this type of things as dispute has taken place, or this type of conflict has taken place, they have put in the AI system, and these documents are thousands and thousands, and AI is reading, because you should not compare with your AI in your mobile phone. They have they have tie up with the companies which is creating AI, and then they are saying, read this document and suggest us what to do, and they are reading. So that day is not far when income tax department will take entire data of yours and can take out where you have done mistakes, where you are contradicting, where your points is not coming, and you are telling not correct information into this. You have spent this money, but you are not showing here. That way, that day is not far. So the message is loud and clear, which professional and ex-bureaucrat is suggesting, that be truthful, give whatever way. And Rajkumar has said also, 15% tax rate is now very less. We can do this. And individual is high, but in corporate tax is there. So we must pay this and use the peace of mind, and then capital build up for future. Thank you very much. Thank you, Rajiv ji.
Thank you. Thank you.
Namaskar.
Thank you.
Namaskar.
Namaskar.
Friends, this journey of knowledge sharing will continue. Our next webinar is on next Friday, and we will come out with a new topic and new things for the benefit of the corporate and the profession. Till then.